Okay, very good. Okay, very good. Well, good afternoon. Happy Thursday. Glad everyone is here to learn about this very important topic on the Corporate Transparency Act that is new for 2024, and everyone's learning and has lots of questions. So this is the opportunity to get all those questions clarified. We will have it recorded, so you're more than welcome to go to our YouTube channel for the New Mexico Minority Business Development Agency and rewatch the video as many times as you like, or send it to other business owners that might also have questions about the Corporate Transparency Act. So welcome everyone. This is the New Mexico Minority Business Development Agency. We're happy to have you here. We have numerous webinars in the coming weeks. This is just a series that we're having with the Law for Small Business. And we actually have today Larry Donahue, who's a partner at this law firm, who does lots of great work to support small businesses and lots of webinars and questions. And they're going to be doing a series of lots of webinars on law topics in the coming weeks. And actually, I wish I had this open and I didn't. But in the coming weeks, we will have on Tuesday, for example, HR Essentials for Small Business. That's from an HR consulting firm that's going to be providing. Then we're also going to have one on New Mexico GRT tax and doing business on the internet. This is also with Larry in the coming weeks. That is on April 11th. And then others on HR. And we're happy to have any other suggestions of any topics that you'd like to see. So without further ado, I will turn it over to Larry. Thank you so much for being here and sharing all this great information.
Of course. Thank you for having me. I appreciate it. And I hope everybody can see my screen. There's one call-in listener. You're not going to be able to see the screen, but you'll be able to get enough in listening with what I have to say. And also we'll make the presentation available to you if you want it. Just reach out to MBDC and they will help, MBDA, I apologize, and they'll be happy to give you a copy of the presentation if you want it. So you don't need to take notes. You don't need to furiously write stuff down. It'll all be here. Also, if you have questions, I'd encourage you to please put a question in the Q&A. I'll try and answer interactively and give you immediate answers back. Especially the questions that are right on point. I might delay an answer a little bit if I know I'm going to be addressing it further down the road, but I'll let you know. I'll try to make this as interactive as possible. But what we're going to talk about today is the Corporate Transparency Act and what you need to know about it as a potential business owner. And please don't shoot the messenger here. I am annoyed by this as much as everybody else. And there's unfortunately the political situation is that it's bipartisan. We can't blame the GOP. We can't blame the Democrats. Everybody's behind this, unfortunately. And it's annoying. And I'm sorry about that, but we're going to try and get through it as quickly as possible. And I'm going to start by giving you everything you need to know on one slide. So if you have to leave at some point, do lunch, whatever, you can leave early. You're going to get everything you need on this one slide. But you're going to find you're going to want to know more. And so you're probably going to want a copy of the presentation later. And by all means, feel free to do so. But we're going to discuss really the two big issues that relate to this. And that is, one, is your company a reporting company? Do you have to report or not? And then the second question is if you do, then who are your beneficial owners? Who do you have to report for the act? And then we're going to talk a little bit about just administrative. How do you actually submit an initial report? How do you update the report? And then, of course, we'll have last minute questions, but I'm hoping I'll be able to answer your questions as we go through this. And with that said, let me click on the right window. And we're now on the one slide that you need to know. And we're going to start with, when do you need to report? And you have to ask yourself, when was your company formed? If it was formed prior to the beginning of this year, January 1st, 2024, your deadline is January 1st, 2025 to file your initial, and I'm going to abbreviate it BOIR, which stands for Beneficial Ownership Information Report. Please do not wait until December 31st to do this. Do it in the fourth quarter. Give yourself time. I'm predicting that everybody in the world is going to just inundate the database, and it's going to slow things down, maybe crash. Hopefully that won't happen, but if it does, I don't want you to call me. Well, let me rephrase that. I do want you to call me. And why is that? Because I'm a lawyer and I make money when you call me. So if you don't want to feed Larry the lawyer, do this early. Because if you run into problems and you miss the deadline, then we got to figure out what that means. The other important deadline is relating to a company's formed after the beginning of this year. So that means January 1st and onward of 2024. And the answer is, if it was formed this year in 2024, you have 90 days to file your initial report. And that's going to decrease to 30 days starting in 2025 onward. So this is going to be an ongoing issue for all businesses of all types. Where do you file this report? Here's the link, fincen.gov/BOI. Now, there's a lot of potential fraud out there. There's a lot of potential. There's a lot of my competition, non-lawyers, saying they'll do this for you. I really want you to be careful, because if somebody makes a mistake, you are on the hook, and there's potential criminal fines associated with that. So, and I'm going to talk about that in a minute. But the rule here is all companies have 30 days to file an updated report. So once you file your initial report, if anything changes regarding the company or its beneficial owners, you have 30 days to file an update. If you do not file on time, or if you file false information, the penalties are outrageous. They're very severe. There are criminal sanctions, imprisonment up to 2 years, and fines up to $10,000. And there are civil sanctions up to $500 a day. And honestly, that's what I worry about most, is the civil sanctions. And the reason being is you think you're just hunky-dory doing everything correct for years, and then you get a little dust up with the IRS or somebody, and now they look at the data in the FinCEN database, and oh boy, it's been wrong for years. Just $500 a day times 365 times 5 years is a really big number that most people can't afford. So the danger here is you think you're doing the right job, and then you get hit years down the road for not doing it correctly. We don't want that to be you. So who are the beneficial owners of a company? This is where we're going to go into a lot of detail in this conversation, but the quick answer is anyone who owns or controls 25% more or more of a company. And that can include anybody that's holding an option or an economic interest only, non-voting interest. An option would be, you have the ability to buy into the company at some point in the future. Guess what? You're a beneficial owner, whether you like it or not. Another possible beneficial owner are folks who have, quote unquote, substantial control over the company, whether they own the company or not. So we're going to discuss a little bit about what that means. When we talk about submitting information for your initial report and updated reports, we have two components. We have company information, and we have the individual owner information, the beneficial owners. And we have to submit what you might, obvious stuff, the full legal name, the where they're located, the address, and tax identification information. And for the beneficial owners, a photo ID of only what you see here. No school IDs, no gun ownership cards, or nothing like that. It has to be a valid, meaning non-expired passport, state driver's license, or a government-issued ID. We do have one question here. The website isn't working on my end. Does it work, not work for others? Is there an error in the website name? Mario, what website are you referring to? Are you referring to what I gave you here, fincen.gov/BOI? That should be working. And if it's not, then it might be a temporary error, or it might be down temporarily.
I just clicked on it and it worked on my end. So
Mario, it's https://fincen.gov, not .com, /BOI, not BIO. If maybe you have a mistake there with the one of the characters might throw you off. Finally, I want you guys to know these two links. The first one is what's called the Small Entity Compliance Guide. This is going to be your friend, and it has a lot of examples, a lot of information, and I ruthlessly stole and copied information from that guide into this presentation. And the reason I did that is because if you have questions, you can go to that guide, and I'm hoping you'll see it in my presentation, and then you'll see it a second time in the guide, and maybe it'll start sticking and making more sense. For me, I have to see things 2, 3, 5 times, or it doesn't stick with me sometimes. So if you're like me, hopefully that'll help. The second link is boi-labs.com. It is a website that we wrote. It has an expert system that basically answers all these questions for you. And so for free, we're not trying to sell this or anything like that. We're trying to offer a community service to help small businesses figure this out without spending a ton of money. And it's a little risky for us, honestly, because it's garbage in, garbage out. If you give us the wrong information, we can give you the wrong recommendation and possibly get in trouble for it. So we have a results recommendation and analysis, and we recommend you do take it to a professional, ideally a business lawyer who is trained in this information to be able to look over the report and say yes or no, or guide you as appropriate, because we don't want you making mistakes and then having to deal with those penalties that we talked about. So this is everything on one slide. And if that's all you care about, you know enough to run forward. But we're going to, the rest of the presentation, we're going to dive into different aspects of this to help you understand how to figure some of this out. Who are your beneficial owners? Does your company need to report or not? That sort of thing. Now, before I jump into that, I do want to mention that there has been a court case on this already. The Northern District of Alabama, it's a federal court, has decided and decreed that this is an unconstitutional act. However, they didn't order FinCEN to stop enforcing. What they said was FinCEN has to stop enforcing only as it against the plaintiffs. So the people who filed that lawsuit don't have to deal with this act just yet, but everybody else, including myself and you, do. I will say that the Biden administration has filed a notice to appeal. They're intending to appeal this. The general consensus among us lawyers, and we're actually working with a constitutional group of lawyers in DC to try and get this act overturned, because we hate it as much as everybody else does. But the general consensus is this Alabama court sort of overstepped its bounds. We don't agree with their logic, and we think it's going to be overturned on appeal. But we do feel like there are unconstitutional components in the act, and it'll be trimmed down over time, but not in enough time for you to ignore this. You're going to have to keep focusing on it. And please, for the love of God, if you're a TikTok user or Instagram user and you're listening to some idiot tell you how you don't have to abide by this, or you can form a trust and ignore it, no, talk to an expert. Listen to lawyers who can get in trouble for malpractice if they give you the wrong information. The crazies on TikTok, and not everybody's crazy. I love watching cats dance and everything else, but when somebody's giving legal advice and they don't have the background or know what the hell they're talking about, I don't want that to affect you and have a big civil penalty down the road. So with that said, let's jump into this. Now, remember that friend I told you about? That's called the Small Entity Compliance Guide. This is a screenshot of the fincen.gov website, and they have resources, small business resources, and get that guide. It's wonderful. The FinCEN did a great job, and that guide is what we used for our expert computer system at BOI Labs. If you go to boi-labs.com, under solutions, there's an evaluation tool. It's free. We don't even ask you for your information. It's a free resource for you to help you navigate this and figure out what you need to do with all of this. So I would strongly encourage you to consider doing that. And it will generate a report like you see down there in the screenshot, which it'll help you understand how it applies to your business and what you can or can't do. So with that said, let's dive down a little bit now and talk about this first big question. Is my company a reporting company? The quick answer is yes, it is. Every company in the US is a reporting company. The bigger question is, are there exceptions? Now, in the small entity compliance guide, there is a chart 1 that I've shamelessly copied and is what you see here. That guide has all these flow charts, and it can get a little complicated and overwhelming, although this is one of the more simple of their flow charts. But the big question is, do you have a company that is registered in a state or other U.S. jurisdiction, like a territory or Indian tribe or nation or, something like that? And if the answer is yes, it's a reporting company. If you have a foreign company, let's say out of Taiwan or Japan, if that foreign company is registered to do business in the United States, then yes, it is a reporting company as well. If you have a company that is not registered, then no, it is not a reporting company. So the big question here is, so if you have a partnership and it's not a formal state recognized entity where you filed it with the state and have a state stamp of some sort, then no, it may not be a reporting company because it's not a company. It's just an informal partnership agreement between you and whomever else. And I would recommend against that, by the way, because there's a lot of problems associated with that, but that's not what this presentation's about. So if you have a company and if it's registered, then it is a reporting company, unless it falls under one of 23 exemptions. And before you look at it and say, oh, I'm a large company, no, what is a large company? We have to dive into the details of what FinCEN says is a large company. Or you say, oh, my company's inactive, I'm not using it, I don't have to report. Not so fast. Now, there are 23 of these, and some of them are obvious, like a government authority. The FinCEN is not requiring the city of Albuquerque or the county of Bernalillo to have to report beneficial ownership information, because who the heck are beneficial owners of a municipality, for example? But there's other things that may or may not make sense to you, like banks or insurance agencies. The reason they don't have to report is because they have other reporting requirements already. So, but there's still specific requirements on that. But there is number 19, tax exempt entity. I'm not going to go into detail on that because we just don't have enough time. But this information is in that small entity compliance guide. It goes into detail on every single one of these. But I'm going to jump and talk a little bit more about number 21, large operating company, and 23, inactive entity, just to give you a sense of what this kind of thing looks like. So with a large entity, there are 6 factors, criteria, and all 6 must be met in order for the organization to claim it's a large operating entity and therefore exempt from reporting requirements. And they're a little confusing. It's 20 full-time employees that are employed in the United States, not contractors, W-2 based employees working in the United States. So if you have a company and you got 20 employees, but 10 of them are in Ukraine or UK or somewhere else, and 10 of them are in the States, no, that's not going to work. You also have to have an operating presence in the US, and you have to demonstrate 5 million or more in net revenue over the past 12 months generated in the United States. So again, if your company is a $5 million company, but 2 million of that is being generated by overseas sales, that's not going to count. It has to be $5 million of revenue generated in the United States. So that's one example of an exempt entity. In a large operating entity will not have to report beneficial ownership information under this definition. An inactive entity similarly has 6 criteria, and all criteria need to be met. And the big issue here is, one is it had to have been in existence prior to January 1st, excuse me, 2020, and it cannot be engaged in active business. That makes sense, but there's some other requirements here that can confuse things a little bit. One is can't have any ownership with a foreign person, even if it's just 1%, won't qualify. Another one is it cannot have any change of ownership in the preceding 12 months, and then you cannot have $1,000 or more of money moving in or out of the company and no ownership of any assets whatsoever. And that's the big one. You can't own another company. You can't own real estate. You can't have shares in a public company. You cannot have any ownership of any assets. If it does, it's not considered an inactive entity, even if there is no revenue being generated whatsoever. So that would be an inactive entity if you met all 6 criterion, and then if so, it would not have to report. Otherwise, you have to report, and you're a reporting entity. So now let's talk about the second big question, and this is the hard one, honestly. There's a lot of details here, depending on how your company is set up. And I was the one that wrote the expert system that we use in the BOI labs. And I use the small entity compliance guide that I referenced earlier to write the program. And interestingly enough, there are a lot of holes and ambiguities in that small entity compliance guide that FinCEN hadn't thought about. And I'll give you one example. We see clients that tax themselves under subchapter S, so they're an S corporation, yet they have different levels of ownership. You're not allowed to do that under S corp tax treatment. So you would actually be incorrectly either taxing your entity or incorrectly setting up the ownership structure. And the IRS rules are, if you ever get audited for that, it's going to push you into a C corp tax treatment, and you're going to be financially devastated. So I'm hoping you're not one of these people. But FinCEN doesn't address any of that in the compliance guide. So how does that affect ownership? So we had to fill in the gaps. And so there are a lot of potential issues and pitfalls you wouldn't even think about, depending on how your entity is taxed and or how you have ownership structures set up. So we're going to discuss some of that right now, and buckle up. It's a lot of fun and extremely boring too, if this isn't your thing. So in order to be able to answer this question, we need to ask a few more questions. And one of those questions is, we have to look at ownership interest and ask ourselves, what is ownership interest? And who owns or controls 25% or more of that ownership interest? And what is substantial control? What does that mean? Who exercises it? And then finally, are there any exceptions to this? If we do have a beneficial owner, can we say they're excluded from reporting for some reason? And the answer is yes. There are some exceptions, and we're going to talk about that down the road. But they're not, don't get excited about the exceptions. They're not there to help you. They're very difficult to utilize, although they're going to make sense when I talk to you about them. Like a minor, for instance, a minor doesn't have to report, but guess what? Their parent or guardian has to report. So, it's really not going to help you much. So we'll talk about all of that. But before we talk about ownership interest, because that's a hard question to deal with, let's talk about substantial control first. And I stole this graphic from the FinCEN entity compliance, the small entity compliance guide. And there's basically 4 buckets here of people who might have, be considered to have substantial control over a company. The first is senior officers, and they're defined by the title as well as the position of authority. So it's going to be your presidents, your C-level executives, general counsel, people of that nature. It's also going to be people who have appointment or removal authority of senior officers or members of the board of directors. And then finally, it includes important decision makers, anyone who's going to direct, determine, or substantial control over important decisions. And we'll talk a little bit more about that in a second. There is a catch-all, by the way, and it's really anybody that has substantial control over the company. And we'll dive into a little bit more detail on that. But basically, who are important decision makers? And you got to think in terms of different components of your business. For instance, in the business side, is somebody making decisions on the nature, scope, or the attributes of the business, like what you might actually sell, different lines or ventures or geographic focuses. And I was giving this presentation to a local chamber of commerce, and somebody said, is my restaurant manager considered a beneficial owner? Do they have substantial control? And I asked, can that manager influence what vendors are hired, or more importantly, what goes on the menu or off the menu? And if the answer is yes, It seems crazy, doesn't it? But if the answer is yes, that's kind of an important decision for the restaurant, and that would be considered an important decision maker and therefore a beneficial owner of the company. That has to be reported to FinCEN. Can they deal with important contracts and vendors? On the finance side, are they controlling significant assets, for the sale or transfer or purchase, acquisition of important assets? Are they making important decisions on investments or spending or equity? Do they deal with compensation issues for senior level people? And if so, then they're probably going to be considered important decision makers. We do have a new question. Mario asks, for those of us who are single owner LLCs, is there a plain, simple guideline somewhere? No, Mario. That's a great question, by the way. And I'd love to say, yes, you're a single owner LLC, but the answer is it depends on your business, unfortunately. And if you have no employees, if you have nobody that's promised an ownership interest, if you have nobody that's, maybe is a silent partner or anything like that, then maybe then you don't have to worry about it. But it's very difficult to just say, don't worry about it because you're a sole member LLC. What you could do is run the program that I mentioned in that link. Run it. It will ask you the relevant questions and it'll give you a answer in analysis. Now, I'd like you to take that analysis to a lawyer to make sure my program didn't puke based on some data you gave it. But, it just depends. I wish I can give you an easier answer and I apologize. I really can't. Finally, is somebody making important decisions on the structure? Can they influence reorganization, dissolution? Can they, improve a merger? They're going to be somebody with an important, or be considered somebody that's an important decision maker. We do have another question. Shirley asks, what about sole proprietor? I'm not sure what you mean by that, Shirley. Are you saying if you have a sole proprietorship, that means you do not have a corporation or an LLC, you do not have an entity that's been registered with the state? If that's true, then no, you do not need to be a reporting, you're not a reporting company. The litmus test is, do you have a company or entity that is registered with a state, with a U.S. territory, or a registered Indian tribe? If you have such an entity, then it's a reporting entity. If it doesn't exist, as far as any state's concerned, because you haven't registered it anywhere, then no, it's not a reporting company. And Shirley says 1099, no corporate LLC, correct. I think 1099 doesn't make sense to me, Shirley, only because what I think you're saying is somebody's paying you a 1099, and that's irrelevant to the analysis. We don't care how you are getting paid. What we care about is the entity or structure you use to conduct business. And if you are going out there as just your own name and you don't register your name or anything as it relates to a company that's registered with the state, then you are not a reporting company and you don't have to report. I know it's a little weird and I apologize, but if you have more questions, please ask or email me and I'll do my best, or use that expert system I pointed out at BOI-Labs. So the big takeaway that I want you to walk away with is beneficial owners. When we say beneficial owners, it has the word owners in it, but it's not necessarily owners in the traditional sense. And so let's dive in and talk about that a little bit. We've talked about substantial control. Now we're going to talk about ownership interest and what that means. And I copied this from that FinCEN guide that I talked about, the small entity to compliance guide. And it is a chart that talks about different ways you can have an ownership interest in a company. Basically, there are 5 categories. First is the equity, stock, voting rights. It's what you think it is. But there's other categories that can be confusing for people. One is a capital or profit interest. You'll see this a lot with partnerships or LLCs taxed or structured as partnerships, where you might have people in control, and then you have other people that don't have any control, but they have an economic interest. The economic interest folks, the capital interest folks, they are all considered to be ownership interest under the Corporate Transparency Act. You have things called convertible instruments. What these are is, let's say somebody loans the company money and says, I'm going to loan you $1 million, but I have the option of turning it into an ownership interest if I want, down the road, 5 years from now. That person is considered a beneficial owner, even though they don't actually own anything today. You also have options or privileges. You'll see this a lot with, profit share employee stock plans or incentives. They're called option plans sometimes, depending on the structure of the company. But if you are offering an ownership interest even later down the road for employees or anybody, that also is a beneficial owner, even if they don't own anything today. And finally, there's a catch-all. And this catch-all is really trying to get people who are trying to get around the system somehow. And I have this every day. I have people calling me saying, look, I do not own the company at all. Then I'm like, well, why am I on the phone with you? What is your question? You said you are part of a company, but now you're telling me you don't own the company at all. And he's like, well, I have my nephew. My nephew does everything. He owns the company. I'm like, okay, why am I talking to your nephew? Well, just because I'm wondering, my nephew does what I say. I'm like, okay, what you're really trying to tell me is, you put your nephew in to do your bidding, but it's your bidding. You are still making the decisions. Your nephew still reports to you. There's an informal, verbal, whatever you want to call it, arrangement between you and your nephew. Sorry, you are a beneficial owner as well. And, how would anybody prove it? Good question. Well, what happens if you get into a dispute with the nephew or the nephew's wife who divorces the nephew and reports on you? Now, you should have reported. This has been going on for 5 years. Remember that civil fine I told you about, $500 a day times 365 times however many years this goes on. It could be devastating for you. So don't play those games. Talk to a professional and see what your options are, if anything. So let's talk about the types of owners real quick. And this can get really confusing for people because when we talk about company ownership, we naturally think, well, okay, who owns the company? As in, what person owns a company? But we do have other types of owners. Companies can own other companies. And we see this a lot where, you'll have an operating entity and then, I don't know, somebody wants to grow their business into Texas or Arizona, Colorado. And so then they form another company in one of those states, and then they get an umbrella company owning all of that. How does that affect things? The answer is you look pro rata at the individual ownerships, and we'll go into more detail and come up with some examples in a minute on what that means. But we also have trusts, and trusts can be very confusing because it depends on the nature of the trust. It depends on the level of control with the individuals associated with the trust. For example, a trustee or other individual who has authority to dispose of or deal with the trust assets. The beneficiary, if the beneficiary has enough power to be able to demand a distribution or withdraw the assets, or a grantor settler could also potentially meet those criteria. And so that means even though a trust owns a reporting company, who are the beneficial owners? The answer is who is ever associated with a trust. And that could create some really interesting issues around beneficial ownership that we'll go into a little more detail in a minute. But what's important to understand is there's a concept now here of direct versus indirect ownership. The direct owners are what you think it is. They're going to be the people that have the individuals that have ownership of the company directly, two partners, for example. And at all times, direct ownership is going to equal 100%. We have another question, by the way. Warren asks, is reporting already in effect, or when is it due, and our $500 a day fine already being assessed? So Warren, I think you might have missed the very beginning, the first slide. The quick answer is you have to file your initial report by the end of the year if your company was formed prior to the beginning of this year. If your company was formed at the beginning of this year or later, you have 90 days to report. Companies formed the beginning of next year onward have 30 days to report their initial report. You have 30 days to file an updated report for any change to your business or the beneficial owners. That's your quick question. And the 500-day fine is being assessed whenever you file your initial report and you don't file it correctly, or you file incorrect information, and or when you don't file your updated reports. So I would recommend waiting to file your initial report until as long as you can. But don't wait till the end of the year, the fourth quarter sometime. If you have a new company, you got to report. I would, and report it. But you also want to minimize the number of beneficial owners if you can, because that creates another liability for you. You have a beneficial owner, they're a silent somebody who gets married and changes their name. Guess what? You got to file an updated report, and they didn't even invite you to the wedding. You don't even know they got married and changed their name. The company can get in trouble for the things the beneficial owners do. And then heaven forbid, what happens if you have a beneficial owner that doesn't play along, doesn't want to give the company the information needed to file the report? What do you do there? The answer is the company's still in trouble. So a lot of issues here, unfortunately. But let's get back to indirect ownership for a minute. Indirect ownership means there's an intermediary. There's an individual that owns a company that owns another company. That's an indirect ownership. And you have the possibility of indirect ownership being much greater than 100%. For example, you have a trust that owns the company 50%, and you have an individual that owns the other 50%. So the trust and the owner, that's 100%, 50-50 each. But you got to look at the trust. And in this example, the trust has the trustee, the beneficiary, a grantor, and a settlor all having control over the assets. Therefore, all of those folks have a 50% indirect ownership interest of the reporting company. So in this particular case, our indirect ownership is significantly over 100%. That's where things can get really confusing. So let's talk about how to calculate ownership interest. We just talked about what is ownership interest, and we talked about who might have it and direct versus indirect ownership interest. But now let's calculate the number, because that also is important. Once we've established somebody has an ownership interest, the question becomes, do they own 25% or more of the company? And if they do, we have to report them as beneficial owners and deal with all the nonsense associated with updating the report if something changes with somebody, or if their photo ID they used expires next month or next year. You got to file an updated report with a new ID for everybody. It's extremely annoying. So the first question you need to ask in determining the amount of ownership interest is, are we talking about a company that issues stock? Is it taxed like a C Corp or an S Corp? And if so, we have to ask another question, and that is, does the company have different levels of ownership interest? Does it have different classes of ownership? If so, then we care about two things. We care about the level of ownership interest, and we also care about the value of their ownership interest. And we have to look at the individual divided by the total amount in each category to figure out a percentage. And here's the problem. How many of you know the value of your company? Not what you think it is, but what it really is, because you had a valuation expert run a valuation and give you an answer. And not just that your company's worth $2 million, but that the individual classes have certain values. That's, I think, really hard for a lot of people. So you need to look at this and figure out what to do about it if you're in this particular situation. If you do not have different ownership levels, different classes of ownership, then you do not need to worry about the value question. You just worry about the ownership control question to figure out percentage ownership. And we're going to run through some examples in a minute. I know this sounds weird sometimes for people. The final thing is, if your company is, I shouldn't have said final. This is the second big component. There's going to be a third in a minute. But if you have a partnership, then what you look at is an individual's total ownership in control over capital and profit interest divided by the total outstanding capital and profit interest for the organization. And that'll give you an individual's percentage, and you would look at that. Finally, there's a fallback, and that probably is going to be for people who don't know the value of their company and have different classes, for example, or you're just doing something different or unique that's not explained by the first or handled by the first two things that I mentioned. And the fallback basically says anybody who owns or controls 25% or more on any class level. So if you had 5 classes, you would make that determination at each one of those classes to figure out what individual has an ownership interest, indirect or direct, 25% or more in each one of those classes. With me still? So let's go through some examples. I'm kind of a dummy myself, and listening to all these rules it gets lost in my head. So examples really help me understand this. And I'm going to use the same examples that are in that small entity compliance guide. So this is going to be the first time you're going to get to review it, and then you can look at it again in the guide. It explains the examples and it tells you what's going on. The first example here is easy. You have individual A that owns 100% of their LLC. Is individual A a beneficial owner? Yes, of course. But let's get a little more interesting. We have a reporting company, and we have 5 individuals, A, B, C, and D. The circles mean they have to report. The triangle does not. And in this particular example, individual D has to report because they're a president, and that means they have or presumed to have substantial control over the company. Individual A and B own 50 and 40% of the stock respectively. That's both more than 25%. Therefore, they have to report. Individual C only owns 10%, does not need to report. This next example is a partnership, and it's just meant to show that instead of stock or shares, units, you have membership interest, and it doesn't affect the analysis at all. Individual A and B are considered 50% owners, which is more than 25%, therefore they have to report. Individual C is a manager. A manager of an LLC is somebody that would be considered to have substantial control and therefore also has to report as a beneficial owner. This is the fun one. This, and I'm sorry for the person on the phone, you're not going to be able to see this mess that is on the screen, but what we have is a reporting company that's owned by a number of different individuals indirectly. It's owned directly by 2 companies, Company Y and Company Z. Company Y and Z both own 50% of the company. The question is, who are the beneficial owners? Now, remember, the circles are those who have to report. The triangles are the ones who don't. What I want to direct you to is individual A. Individual A owns 30% of Company Y. Company Y owns 50% of the reporting company. So company or individual A is considered to have a 15% indirect ownership of the reporting company due to individual A's ownership of Company Y. Now, if that analysis just stopped there, individual A may not have to report, except individual A is a CFO of the company and so has to report because of having substantial control over the reporting company. However, in this example, individual A also owns 25% of Company Z. Company Z owns the reporting company 50%. So what that means here is individual A owns 12.5% indirectly of the reporting company through his ownership of Company Z. Now you add up his indirect ownership. So he has 15% from Company Y and 12.5% of Company Z. I believe, what is that? 27.5% if I'm doing my math correctly, which is greater than 25%. So individual A then would be considered a beneficial owner associated with his or her indirect ownership of the reporting company. Fun stuff, huh? Let's look at individuals D and E, for example. Individual D owns 25% of Company Z, which in Company Z owns 50% of the reporting company. So this means individual D has a 12.5% indirect ownership interest of the reporting company. That's lower than 25%. Therefore, individual D does not have to be a beneficial owner for reporting purposes. Fun, crazy stuff, isn't it? So we have about 14 more minutes. Please ask more questions if you have them, but I want to dive into some more administrative stuff. But let's start with the exceptions. And I mentioned one earlier, a minor who doesn't have to report. And the first one is a minor child as defined in the jurisdiction they live in. So if the different states could have different rules about what defines a minor, as well as a territory or Indian tribe, and you look at where the minor is located. If you're going to assert that exception for the child, the minor child, you can only do that if there's a parent or legal guardian that will then submit their beneficial ownership information instead. And then, of course, once the minor reaches the age of majority, meaning no longer a minor in the eyes of the jurisdiction they're a resident of, then they're going to need to report their beneficial ownership information. Another exception is what's called a nominee or intermediary, custodian, or an agent. That makes a lot of sense, for instance, like a tax professional. If you have a tax advisor or somebody advising you on the business and helping you make decisions, that person would be excluded as a beneficial owner, but it's only because they're acting on your behalf and you still have to report, but that, advisor, lawyer, accountant, whoever would not necessarily have to report. The other exceptions are an employee exception. And this one's an interesting one. There are 3 requirements associated with this. And one of them is they're an employee, a W-2 based employee, not a 1099 contractor. And their relationship to the company is only related to their employment. Their economic status is only derived from employment. There is no other sort of economic benefit from the relationship. Also, that they're not a senior officer. So, for example, I have a controller in my law firm. That controller does whatever I or my other partner tell that controller to do. And if it was judged he was making decisions about vendors or something like that and considered a beneficial owner, we would be able to take care of this exception and claim him as an employee exception because that's all he's doing. It's only relating to his employment, and he's not a quote unquote senior officer. But in my example of a general manager of a restaurant, I would argue that person probably is a senior officer of the company, even though it's not a president per se. They're still making significant decisions and probably would not be able to take advantage of this particular exception. There's a few others. One is inheritor. This makes no sense to me. I don't know how many people know they're even on a will to inherit a company, but once they do inherit, then they would, of course, have to report. There's a creditor exception that's interesting. This is not meant for somebody involved in the company lending money to the company. This is really for like a bank or other institution or even an individual, a creditor who has given money to the company and is using some level of ownership interest as collateral for the loan only, not making decisions, not doing anything else, just holding ownership interest as collateral. We have another question that is, I'm on the government website filling the report. Under Part 1, reporting company information, tick box, request to receive FinCEN ID. Do I check this box or leave it unchecked? That's a great question, Mario, and I'm just about to cover FinCEN IDs. And so the quick answer is I would recommend you get a FinCEN ID. I think that will make things a little easier for you. Although, if I'm remembering correctly, and you're the only one involved in your company, it's not going to be that important. But when you have other partners, other beneficial owners, it makes things a lot easier if you deal with FinCEN IDs versus all the private information and a copy of their driver's license. So there's one more exception for the BOI reporting for beneficial owners, and it's buried in the small entity compliance guide. It's not actually numbered. And what that exemption is if one of the beneficial owners is an exempted entity that we talked about earlier, for instance, a bank or a government authority or something like that, you just report that owner. You don't report the beneficial owners of that entity. So that would be another exemption you have to deal with. So let's go through some mechanics quickly. How do you submit? And I talked about it briefly. You go to fincen.gov/BOI. And if you're going to be doing this a lot, I would recommend getting a FinCEN ID, because you don't have to worry about the individual data underneath the FinCEN ID. And what I mean by that is if you had a, let's say you have two beneficial owners and one of them is an employee, have the employee go and get a FinCEN ID for him or herself. And here's the link for it. It's at FinCENID, FINCENID.fincen.gov. And then your employee is directly giving their information to FinCEN. So you as the business owner don't have to worry about it. All you care about is the FinCEN ID. And then that's what you report. You don't report all the other stuff. And I'm hoping that'll make your life a lot easier, because all you have is the FinCEN ID. You don't know if Mary gets married and changes her name. You don't know if the driver's license she used to prove her identity has expired. You don't have to worry about all of that. All you have to worry about is the FinCEN ID. So if Mary quits and you replace Mary with somebody else, you have to update the report for that, and tell FinCEN that Mary's no longer with the company and that you've hired somebody else. But all you have to worry about is the FinCEN ID, not all the other ancillary baggage. If somebody moves their primary residence, that is going to be cause for an update. So having them get the FinCEN IDs will improve your sanity, because you don't have to monitor and maintain all of that if somebody else, or if they do themselves and just give you the FinCEN ID. So, and I mentioned this earlier, the information that you need to keep track of is going to be the full legal name of the company, any trade names, DBAs, the complete current U.S. address, and it can't be a P.O. box. It cannot be a mailbox, virtual mailbox, or what's called a CMRA with the Postal Service. It has to be an actual physical address somewhere. And then the jurisdiction and taxpayer information. For all the beneficial owners, you either need their FinCEN ID or you need all of this: their full legal name, their date of birth, their complete address, and a unique identifying number of the issuing jurisdiction of one of the following non-expired IDs: a passport, a driver's license, or a state ID issued, or a foreign passport if they don't have any of the others. So it's much better to make the individual beneficial owners deal with that themselves and get a FinCEN ID from them. So updating the Beneficial Ownership Information Report, or BOIR. You have to do that at the same place, fincen.gov/BOI. And it looks like they've been changing their interface a little bit. So what I'm telling you now could change very quickly. But what's been happening is when we first looked at this, that you couldn't just submit your initial report, and then when you do an update, just go and change one little bit of information. You had to go and give it all the information again, which is annoying, because that means you got to keep track of everything yourself versus using FinCEN to keep track of it, and then you just update it. Now, that's the way it was when we were looking at it the beginning of the year and early last year, like in the December timeframe. They have since, it looks like you can make some edits and changes now. And so it looks like they're improving their interface, but I don't know to what extent this will be true. So what you really want to do for now is, if somebody doesn't generate a FinCEN ID for you, then you need all that other information, and you need to keep it current and up to date. So if somebody moves their physical address, if they change their name, if they, change their position within a company, so that they are no longer in control, or you promote them and now they are in some sort of control, you're going to have to change that and update your report. So you need to keep track of that. And you have 30 days to do this. Otherwise, you can put yourself in the fine category at some point. Now, I don't think FinCEN is looking over these millions of records and randomly auditing them. I don't think that's going to happen. So I don't feel like if you make a mistake, you're going to get a bill from FinCEN with a fine on it. I don't think that's going to happen. Which is both good and bad, right? It's good because you don't have to worry about it. It's bad because you can make mistakes and not know it. And when are you going to get hit with this? Well, maybe you get audited by the IRS, or there's some sort of weird lawsuit, or the government gets involved because you're not doing a permit properly or something. And somebody investigates and says, "Oh, look at this. You've said this is what your report says, and this is nothing like your business." Now you're in trouble. That's the problem. There's no feedback mechanism. You don't know if you're doing this right or not. So you may just be in ignorant bliss for 5 or 10 years and then get the hammer. And so, I'm not trying to panic you. It's just, it makes sense to try and do this right and keep track of all of this. So just an example of things that might need changes, anything regarding your company, whether you have a new DBA or you move the address or you change ownership, or you change key employees, would require an updated report. Any change to a beneficial owner, whether they die, they get married, they change their name, they move their primary residence, the ID that's used, if it expires, now you got to give a new ID. So that's going to require an updated report. So you got to keep track of all of that. So anyway, that is it. I can be reached here. I'm a law firm, Law for Small Business. If you have questions, please reach out. I strongly encourage you to use that free expert system I talked about. It asks all the questions that are needed and then try and give you a reasoned answer on how to approach things. And then I appreciate your time. I really thank you. If you have more questions, please type them out now. Otherwise, have a great life, and remember, don't wait till the end of the year to file your report.
Well, thank you so much. There's a lot of beneficial information for all our business owners. I'll very appreciate what you actually did today. All this session is going to be recording, so please be advised that you can always look it up at YouTube channel that we have. So again, thank you everybody for being here, and we'll see you next time. Thank you, Larry, so much again for what you did today.
Of course, thank you. We put a physical. There is one more question from Mario.
Oh, there's one more question. Okay, let's look at the question. Yeah.
Mario asks, we put a physical address wherever it asks for an address, correct? We can never use a PO box, right? I don't know what question you're looking at, but when you're identifying individuals in the company, you can't use a PO box. I don't know if there's somewhere else, for a mailing address for convenience, maybe you can use a PO box, but not as it relates to identifying where the company is located. It asks for an address multiple times. I have my assistants using that form. I'm sorry, Mario. I don't know which one you're referring to. But if you wanted to email me, I can probably have one of my staff reach out to you.
Okay, if there's no other questions, we're going to end this session. Again, thank you everybody for attending today. And hopefully Larry can give us more classes eventually. And again, this is going to be recorded. You can actually review this video on our YouTube channel. Thank you so much, everybody, and have a great day.
Bye, everyone. Thank you.